started, guys. Thanks for showing up. And the first thing at hand is yes, I pushed the record button. So yes, we are recording this webinar. The
Awesome.
good news is GoToWebinar recordings have been very, very stable for a real long time. It's a very, very high probability that the recording will work properly. Yes, we will send you the recorded version when we're done here. However, from time to time, things break, things don't work right, GoTo crashes, the recording doesn't work properly. So with that in mind, please pay close attention. Put the cell phone on silent, skip the emails, whatever. Just focus in, get your notepad, your paper, right, and pay attention because the recording might not pan out. Also, with that in mind, you should have a GoToWebinar icon or button somewhere on your screen that you can click, and there's a spot there that you can click and you can type in any questions. So as we're progressing through the presentation here, if any questions come to mind, just get them in there as we're going through. And at the end of the presentation, Tom and I will field those questions, as many as we can. And what I mean by that is there just might not be enough time to field them all, or some of them may be too technical for what we're doing. I want you to know that don't worry if we don't address your question here on the webinar. All those questions are forwarded over to Angel Oak, and one of their account executives will answer you directly, give you a call directly, and answer that question for you, so no need to worry about that. With that, I think we're ready to go. I'll introduce our presenter and host, Tom Hutchins. He's the EVP of production over at Angel Oak Mortgage Solutions, our non-QM sponsor on the National Real Estate Post. Of course, I'm Frank Array. We appreciate you guys being here, and today's webinar is a cool one. We've done this one now 3 or 4 times because it's been very well received.
Yes.
And what we're going to be talking about, guys, is the concept of a residual income in the mortgage space and an actual residual income strategy in the mortgage space. And it's a pretty simple concept, but it does require a little bit of a thought process and a little bit of a plan to really make it work for you. And that's what we're going to roll out. We're also going to show you how to get the pipeline, start filling up the pipeline with these products so
Right.
that you can implement this strategy for this residual income. So very good webinar. And with that, I'll hand it off to you, Tom. Take it away.
Sure. Well, that's perfect lead in, Frank. I was just going to kind of go over the outline since you were starting to talk about that, but we are going to talk just kind of right out of the gate, the whole residual income concept and how non-QM fits into that. And then after that, we're going to talk about the strategies to implement the follow-ups and things that are required. Then we'll jump into like just non-QM as a whole, how to grow your pipeline, strategies around that, and then finally scenarios. And I'd like to just go ahead and say now, you had said send in any questions you have, but if you have any scenarios, non-QM scenarios, feel free to send those in, and we can talk about those. And like Frank said, if we don't have time to get to them, we'll at least have it documented, and that information will get to us, and we'll be sure to get back to you. So let's go ahead and jump in. We good, Frank? Yes. Okay. Here we are. Non-QM exit strategy, and this really kind of is an illustration of what we go through in the mortgage business. Every single month we close our volume, and then at the end of the month we're back to zero. And if that's your business model, hey, it works. But wouldn't it be nice to have to start each month with kind of a pipeline, a built-in pipeline that continues to come to you? So we're calling it portfolio products here, but really what we mean are non-QM. It's non-agency loans. If you have non-agency business, what your business looks like is you close one of those loans, you set a calendar reminder for X date in the future to refinance a borrower, and then you've got that loan hitting your pipeline in 2 years in the month that you set. And the reason that we started talking about this is that's what we're finding out from our clients. We've been doing this for 5 years exclusively now, and we have a lot of originator partners that shared with us in 2018 a good percentage of their volume each and every month was this residual income from non-QM loans they had done the year or two prior. So that's why kind of when Frank and you and I were talking about this, we thought this would be a great strategy because it's never too late to get started. And if you do it now and you implement what we're going to talk about into your business today, it's not going to pay dividends necessarily next month, but in 2020, when it's time, this residual starts building, you'll thank yourself for implementing these strategies, because this is just additional volume. This is volume that you otherwise are not going to see. So I think that's really important. And really the most important thing, there's a few that we're going to go through, but one of them is, when you're into this, know your exit strategy, know the end game for that borrower and for that situation. So when you're originating a non-QM loan, look at that borrower situation. A really common one, almost half of non-QM origination are borrowers that have some type of credit ding. So you need to know when the seasoning or when that credit issue will be resolved. And you need to know it for two reasons, really. One is so you can put together your follow-up strategy. But secondly is that helps you really be a consultant on the front end. I think I heard, was it Barry on your show a couple of days ago, Frank? And he talked about being a consultant. An
advisor.
An advisor. Every loan officer, how important is that? You have to be an advisor. If in today's age of technology and web this and web that, people want advisors. That's who they want to work with. And so if you know your exit strategy, that should be part. We say sell the loan up front, but it's not really selling the loan, but it does help you be that advisor and give the borrower some, a bit of a comfort level. Okay, this is what we're going to do now. This is going to get me in the house now. But then in 12 months, 18 months, 24 months, we're going to come back and we're going to do this. And that is, to me, a really important part of this entire process. We get questions, Frank, how do you sell the rate? And, that's not what this is. This is not selling a rate. This is being an advisor, saying, this is your situation, and with your situation, this is what I can get for you. And 2 years from now, this is what we'll do for you then. And so then it's not even about selling anything. It's just advising the borrower of their current situation and how you're going to make it better.
Yeah, it's presenting a plan is what it is.
Yes.
So if you're presenting a plan, then the rate factor, it's there, but it's not the driving force behind it. The plan is the driving force. Right.
Yes.
The non-QM product's just the tool to facilitate the plan. And if you guys are getting it, if you're not hearing what Tom's saying, I'll reiterate it. This plan comes with 2 deals for you, okay? At least 2 deals. The first one that we're going to get them now, and the exit one that we're going to get them 2 years down the road. Right. So it's a plan that we're presenting to a borrower that comes with 2 engagements, loan engagements with that borrower. And then we're going to talk about some stuff in between. So go ahead, Tom. Sorry to interrupt.
Yeah, no, you're right on. That's exactly what it is. It is planning the whole process for this borrower up front, giving them that comfort level. If there's any pushback on rate or whatever, when you then break that down to payment and say, hey, listen, you're going to have to pay a couple $100 extra but that's for 2 years. And look, you're getting this house now, and look at the appreciation you're going to get. There's so many tools where, again, you can be that advisor that, hey, paying a 5.5%, 6% rate instead of the 4.5% rate, it's not even a discussion. Once you've become that advisor, you're going to address all that up front. So really no issues. So anyway, then we just kind of thought the proactive piece, set the calendar reminder. I already showed that to you, but it doesn't have to be something that technical. I've talked to a lot of loan officers about it, and asked them what kind of CRM do you use, and gosh, most of them, they just use an Outlook calendar reminder. They just go in at X date and maybe back it up, and they put in there, call XYZ borrower for that to finalize the refinance. So
you can just use Google Calendar.
It's anything that'll just remind you, so you don't have to remember it yourself. So anyway, there's a couple examples here. That's not really that critical. We're going to talk a little bit more about it. So here's the importance of follow-up, and it's really these are examples if you have a poor habit, you close one of those loans, you forget about the borrower. You don't even reach out to them. Then they walk into a bank and a lot of these banks, they're doing loans, right? So they walk into the bank a couple of years later and say, hey, I'd like to talk to you about a refinance. And that loan will get refied right under your nose because you didn't create the habit up front of following up and being proactive. Same thing. Close a portfolio deal, one of these non-QM, non-agency loans, and a few years later, they're at a party, they're talking to somebody, and that somebody says, oh, I know somebody who can help you with that. And they refer that borrower to another originator. And again, you've lost that loan. So the proactive piece, the planning piece, just like you said, Frank, have the plan and put the plan in place. That's a really key ingredient to this whole thing. So then there's follow-up. You want to kind of talk about that, Frank? Just position this.
Oop, there I am. Sorry. I can turn on my phone. Absolutely. Yeah. No. Yeah. So I mean, let's just talk about engagement with this, and let's review the plan. This is like the easiest plan on the face of the planet. Number one, we got to find the non-QM deals and get them in the pipeline. We're going to talk about that in a minute. So hang tight. We're going to show you where to find them. Okay. So we got to find the non-QM deals. And we get the non-QM deal in, we're presenting a plan, right, to our borrower, just like we said. And we're going to have part A of the plan, which is let's get you into the property now, making use of the non-QM product, because that's all that's going to work for you, right? But plan, part B of the plan is, like Tom said, when you're doing this loan, but you're telling them about the next experience you're going to have on this loan. We're doing this loan today. 2 years from now, we're going to look at redoing it into a prime product or a different product when the time comes 2 years from now. When we're past our issue that's making us not fit the box today, right, we'll do another deal and we'll schedule a time right now. So on the next slide, I think we'll show that the main point is once we get that deal going, we have to immediately schedule the refinance appointment, right? We want to do that right away. So maybe right when the loan closes, right? We close our loan. We know we're a done deal. We immediately schedule that refinance time. And I know, Tom, your guys that you've talked about this said that what they do is when they immediately schedule that, they're on the phone letting them know, I've already scheduled when we're going to do this. It's in my calendar. I'm going to be getting a hold of you so we can take care of it. So just so you know, and I'll be staying in touch with you along the way to make sure everything's progressing as planned, right? This is what we have to do with these clients, right? So if we're gonna tell them that we're gonna stay in touch with them along the way, and we've already set the refi date, and that's all set up, now we have to do some more scheduling in our calendar, which would be the next slide, which is we've got to set up the quarterly reminders, right? Now this is an easy thing to do in any type of a CRM like Tom was talking about. This could even be Google Calendar. You can set up Google to-dos, reminders, schedule them to pop up on your calendar, or whatever the case may be. But we're going to schedule at least a quarterly follow-up with these deals, and we're going to get them on the phone, and we're going to have a conversation. I'm here to tell you guys, you know what? Me and Brian have been preaching this, Tom. It's like, there's these mega tech companies out there in the mortgage space that live in the clouds. Okay. And they're massive. And for us little loan guys down on the street, okay, we can't compete in that arena. We'll never have that technology. We'll never have that reach. They've got the most brilliant minds coming out of Brown and Harvard and, helping them create all this stuff in the clouds. But where they can't compete with you guys is on the street, right? They can't compete with you putting in a quarterly scheduled call. And they can't compete with you if you make the call. Where I was going with that is this has to be a call. It has to be your mouth to their ear engagement, because that's where they can't win. Okay, that's where you will win, because they can't be there, but you can be there. So what I'm saying is, when we schedule these quarterly reminders, please don't just send an email. Okay, please don't just send something electronic, because now you're going to be in the cloud space. All right.
Hey, Frank, I'd like to interject there, because I see a lot of loan officers that, and even just through their companies, regardless of their size, they might have the technology to have these CRMs send these automated messages on a quarterly basis. Those kind of, that's not what we're talking about here.
No.
That's why I love how you're saying it, Frank. It's a call, because we all know what is generated by a computer, right? You get those emails, you don't even really have to open them because you know that's where they came from. So the phone call, though, that's how you differentiate yourself. That's how you keep that relationship with the borrower going.
That's right. That's right. In fact, a lot of times the automated email drips and all that kind of stuff kind of condition our borrowers to ignore us, right? Because they see it, they like you and everything. They're not necessarily going to open that thing up, right?
Yeah, and they're good, and they're good to do. Like, you know, it's important to do that. It keeps you in front of them on a regular basis.
Yeah.
It's just you can't rely on that to be all of your efforts.
No. If you want to get deals, let's put it this way, out of your email drip reminders, you may get something. But if you're making phone calls, I know you'll get something. Okay? Right. I know you'll get something. So we want to schedule these to be actual phone calls, and then we want to follow up. Now, what do we say on the call? Let's take a look at the next slide. So on the next call here, on the call here, guys, it doesn't matter what you say. All right? It's okay. You don't have to have a script. You don't have to have something to talk. You're literally just calling these people and saying, "Hey, man, how's it going? How you doing?" And they're going to go, "Good, man. How are you?" You say, "I'm doing good. I'm just touching base. You know, we've got our plan in place. We've got here, remind them that we set the refinance close, right? We've got our plan in place. We're looking at about, a year and 9 months before we do that, something like that. But I just want to stay in touch with you just to see how you're doing, see if anything's changed or anything like that. Is everything going okay?" And then you're just going to have small talk. Just have small talk. And so this small talk that we're going to have on a quarterly basis is obviously going to help us secure that future loan that we've already set up to do, obviously. But we're in sales, and we're originators. And we're here to help as many people as we can right now, right? So before you hang up the phone, we're going to actually leave them with a little script. And this will be your only script. And we could show that on the screen, Tom, the next slide.
Yep.
Before we hang up the phone, right, when we touch base with them, we're going to say something like this. "Hey, just as a reminder, before I let you go, just trying to help as many people as I can right now. So with that in mind, is there anybody else that I can talk to who might need my help today? Oh, and by the way, there's lots of down payment assistance available out there for first-time home buyers. If you happen to know anybody that might fit that as well. With that in mind, is there anybody I could talk to?" You're just going to ask for a referral, right? And you got to keep in mind, these guys that you helped appreciate you. They like you, right? They know you help them out, And I find that in general, people are willing to help, right? People are willing to help. People want to help. If you ask them for their help, you'll be amazed at the response that you'll get, from these people, where you will get referrals. If you do a quarterly call along the way, think about this. We got the one loan. We're making quarterly calls. I guarantee you're going to pick up another deal. At least one more deal you're going to pick up just by asking for the referrals. And then you're going to get that closing refi, right?
And Frank, sorry, I didn't mean to cut you off there, but one of the reasons why is because your client that you've closed a loan for, others know that they just bought a house, right? So they're at a party and somebody talks to them about, I just bought a house, and they, this is another person who's thinking, well, we want to buy a house. Hey, by the way, who'd you use for your loan? Who'd you get your mortgage through? Those are conversations that happen all the time.
All the time.
If you're the one asking your customers, hey, have you talked to anybody in the last couple months? I'd like to help them out. They're going to remember, oh, yeah, I did 2 weeks ago at a party in the neighborhood. So that's networking 101.
Yeah. So it just comes down to, and I think our next slide is just a big slide that just says engagement. Is what it all really comes down to. And here's what I need you guys to understand. Let's put this all together, okay? Because we're about to start showing you guys how to find these deals, okay? if you put in a little bit of effort to go out and find these non-QM deals, the weirdest thing is going to happen, and that is you're going to find them. Okay. If you put in the effort to find them, the way we're about to show you with a few ideas on where to look, right, you're going to find them. And here's what you have to remember, just exactly what Tom said at the beginning. And this truly is residual income, because if you're doing, let's say you start tomorrow digging up these QM deals that are out there, and there's a lot of them. You've watched our show where we've reported many times on Angel Oak, not because they're our sponsor, because they're in the news, okay? Blowing up, growing. So much business is going on. That's why we're doing these shows on them, because they're in the news, right? You're going to find these non-QM deals, and you're going to be able to start participating in this explosive growth that's going on in this non-QM space, which means if you could start getting a couple deals a month, starting this month, right? A couple deals a month, non-QM deals. And if you do that every month over the next 2 years, what Tom is saying is that's going to guarantee you 2 deals a month going forward for the next 2 years after that. You see what I mean? I mean, it's guaranteed. You can't lose with this plan. But it does come down to finding the deals and then doing the proper engagement. So with that, maybe we can, if you'd like to get something to add.
No, that's exactly right. It's residual because of just what you said. In 2 years, these loans are going to start coming back, and you're going to be adding new deals every single month. So it's the layering effect. So that'll become a significant portion of your business. The other piece that I just want to share with you from our originating partners is that doing non-QM loans opens up doors to do agency loans with new referral sources. So that's why we're kind of going right now. Where do you find these borrowers? And obviously the first place to start is realtors. Realtors, hey, they're the first line of defense. They've been very well trained after the crisis of what questions to ask potential home buyers, because they've seen deals not work. So they ask, what's your employment situation? What's your cash situation? Income, they kind of pre-qualify a lot of these borrowers for you. So if you go out to realtors and say, listen, I've got some new products and some new programs, they're going to get really excited. A very common non-QM loan is the bank statement loan. And we go out with loan officers across the country and make presentations to realtors. And the realtors get so excited. And you know why? Because they need a bank statement loan. They've been cut out of the mortgage market since the crisis. So they get it. They understand it. And they know lots of people that they've had to deal with that couldn't get qualified for credit reasons or self-employed income reasons. So realtors is really the place to start. And then if you close a non-QM loan, that's going to open up doors from those realtors to, hey, I'd like to have a shot at your agency borrowers as well. And they have no problem with that because you did a great job for them on the last loan.
Oh, definitely. If you wind up doing a deal for a real estate agent and get that agent into a house, I mean, yeah, you're pretty much going to be in a good position to scoop up their future business.
No doubt about it. So this is another one that I know you like to always talk about, Frank, but just the other loan officers. Large banks, they're not, the loan officers there, they are not participating in the non-QM space at all. So between them and credit unions, if you know originators at any of these locations, you need to put them on your milk route to go see, because they have these borrowers come to them all the time and they simply say, sorry, we can't do your loan. They don't want to do that. They would rather refer them to somebody that they can trust, because the credit union or the bank probably has a relationship with these people. So they would like to send them to you. They just don't know you're the person that they should be sending them to. So make that, in fact, Frank, I remember you showing on a Google map, you can pull up all the credit unions within a 30-minute radius of you. And
totally.
Put them on your list. Go see them.
Just go to Google, right? Just go to Google and you just type in, bank or credit union, type in credit union, and it'll just go on the map. You'll see all these credit unions, and I guarantee you, they probably all offer, agency loans. They probably all offer agency loans. The truth is, a lot of them probably don't do govies. right? They probably
Right.
don't do FHA, VA. And
Right.
for sure, none of them are doing non-QM.
Right.
So for you to go in and establish a relationship with those loan originators, I mean, you can definitely pull some non-QM business out of there. The other thing too is just to be safe, what you may find is, and bring up the map is good because you want to kind of spread out that search about 20 miles or so, because some of those loan officers in those credit unions may actually be trying to do business with the local real estate community in your very city. But
Yep.
so they might feel weird about giving you a referral because you're in the same area. But if you go outside, you know what I mean, to the credit unions that are a little bit of a drive for you. Let's say you got to drive 30 minutes to get to a couple of them, right? You're not necessarily in their backyard, and they're probably going to feel maybe a little more comfortable because you're not right next door, right? Referring you over to a client that they weren't able to do. It's a brilliant way to look at getting that business.
And it works. We have examples of loan officers that do this, and it absolutely works. Another one is builders, developers. Builders are always looking. They want every potential buyer that walks through one of their model homes to be able to get a loan. So they are always looking for ways to expand product offerings, and they are also very aware of the limitations following the crisis of just agency and government loans. If that's all you have to offer, they know they're missing out on selling houses. So get in front of them. Obviously, accountants. We talked about the bank statement loan, but accountants know the self-employed borrowers that they have a lot of write-offs with, and they know the ones that really qualify and deserve to be a homeowner, but because they do their job, which is be a good accountant and take advantage of the tax code, they write off a lot of those personal expenses. So they are a great source to find the borrowers that have the write-offs, because the accountants are the ones that are working with them every single day. And then obviously, we talked about credit events, but bankruptcy attorneys, they obviously know who the borrowers are, potential borrowers that have had bankruptcies filed in the last couple of years. So good referral sources.
Definitely. All
not new ones, but you have a new story to tell with non-QM, right? It's the same old, hey, just send your agency loans to me because I'm really good and I provide great service. You're coming to them with something new and something different, and something that they're not, are more than likely not even aware of. So good stuff.
Right. You're coming to them with a pitch. You know what I mean? You got a pitch. And I know we're going to take a peek, and we're going to go through some of the scenarios that you've got lined up that are examples of what you guys have done. And we'll probably touch on this later. But while we're on, here's all the places you can go find the business, just so you know, and I know Tom will probably touch on this. If you guys can get all the marketing material for all these niche products, and you can brand yourself on it right from Angel Oak. So when you go out to the realtors, you've got something to hand out, or go to the credit unions, you've got something to give them. So, it's not just going in with your card saying, I can do this and I can do that and I can do this. And it's like, no, here you go. I've got a borrower that fits this. I can help, so that's available to you from Angel Oak. So they're really giving you the plan, where to find it, and the assets to go and dig up that business. So
maybe Frank, if we have enough time, I can show everybody on our website
let's see. We'll see how we're doing on time. Let's go ahead.
All right. So here's a couple scenarios, and these are real deals that we've closed. But this was a president of a casino wanted to leave New Jersey and move to the Southeast. They had a vacation house that they got underwater from the crisis, and eventually gave up on it and had a short sale in 2015. But as they're moving, wanted to buy over $1 million home, pretty good credit scores, good income. They wanted a 90% jumbo, but with a recent short sale, you're not going to get a 90% jumbo unless you look to non-QM. So we have a non-prime housing event. This one actually closed a couple of years ago, but this is just the example of how you set this up for residual income. So closed in January, jumbo financing, quarterly follow-ups, and right now they're getting to that 4-year seasoning from their short sale, and at 4 years that starts to open up more products. So the plan with this borrower right out of the gate was, I get you into this house now, but in 2 years, we're going to refinance you. And if you follow the strategies that we talked about, the quarterly updates and the quarterly phone calls, this ball is getting teed up for a refinance coming this spring. So this is what we're talking about. And had you been doing this 2 years ago, you'd be in this position now of having residual income by originating these non-QM loans. So anyway, I thought that was a good scenario just because this has happened. So then we have another one, a doctor moving across country, had a short sale 2014, 700 purchase price, 716 FICO, good salary, they're a doctor. How do they make this work? So 90% jumbo again, closed in July of 2017. So quarterly follow-ups, called them again, June of 18, and this one actually did refinance into our platinum program in August of 2018. So again, two loans. Think non-QM is not one loan, it's two loans. And if you don't do non-QM, think of how much you're missing and losing. Not only the two loans, but you're losing on the potential from the referral sources, the realtors that sent you the deals, the builders, all those sources that we talked about. They're going to open doors and give you more loans than just the one that turns into two.
Yeah, it's absolutely true.
Yeah.
Plus, I think we're clearly making the point here that, jumbo deals, jumbos, if you're in the quote unquote agency world of jumbo, they're a tough nut no matter what. There's a lot of reasons for a lender to say no on a jumbo loan. You know what I mean? And that's where Angelo can really shine for you in that area, because when you get the traditional jumbo lender to say, "Nah, doesn't fit, sorry," it's like you got it covered, over at Angelo. So
yeah, no, you're exactly right. And jumbo loans, we know agency loans the guidelines are tight, but jumbo is even tighter. So
right.
What a lot of people don't know, Frank, is the average loan amount in non-QM is over $400,000. So the average is jumbo loan sizes.
Yeah.
Hey, if you're going to write loans, you might as well write big ones, correct?
Big ones. Two big loans.
Here's another. Just borrow at a 679. They need a 680. That's again that tight jumbo requirement. 680 is like the end all be all cutoff. And I think maybe you've heard me say before, half of Americans have a credit score under 680.
Yeah.
So already starting with a smaller pool, but this was a real scenario. They had to close on the loan or the seller was not going to wait for them. So put them in a new house, good income, did an 80% loan, closed on a high-rise condo, quarterly follow-ups, and they refinanced in just a couple months ago into a prime jumbo. So it's just those are the kind of things that you just have to be aware of what's going on out in the market, and this is the perfect example.
Cool, man. Cool.
Yeah.
I'm actually looking, and people are kind of putting some scenarios in. There's actually a couple here that I think we could address real quick. Could we maybe go to quick quote and start looking at that, and then maybe we could?
Oh yeah, sure. Yeah, that was kind of our next plan anyway. So.
Oh, okay, good.
All right. So one thing that I would like everybody just to remember from this is our website, angeloakms.com. But right here we have what we call our quick quote, and all you do is you click on it, and it goes right into. It's kind of we call it quick quote for that reason. It's just a quick scenario where you can look and see, is there a potential loan for this borrower based on this scenario? So we're here, quick quote right on our webpage. So did you have a scenario that you wanted to throw out, Frank? Is that what you were thinking?
Yeah. Let me look here. There was a couple. Hold on.
Okay.
Okay, hang on. Let me see. I got one here.
Okay.
Okay, here you go. All right. Borrower wanting to close on a $1.1 million home. They were turned down by two of the lenders due to a short sale.
Okay.
That a short sale was less than 2 years ago.
Okay. Yep.
And FICO 683.
They put a FICO on there. Okay. Cool.
683. LTV 70.
Okay. All right. So LTV 70. That put our loan amount.
Yeah.
$7 million range. LTV 70. And what did we say? Short sale less than 2 years?
Less than 2 years.
Okay, so so right here it says short sale, greater than 12, less than 24. And as soon as you select that, it starts giving you options. Oops, sorry, I changed it. But so right there, you see our non-prime product. They asked for a 70. We could actually do up to a 90 for this borrower.
Wow.
Gives you the rate. And you're kind of, that's like step one. That took, what, 15 seconds to read?
Yeah, pretty fast.
Yeah, pretty fast. And you can change all this information. You can change it from a purchase to a refi to a cash out, the credit scores, any of it. And as soon as you make the change, here, I'll just change it to 80. And as soon as I make, oh, that's a little technical. So change it to 75, it immediately updates it. So it's very simple. Just easy to work with.
Yeah. I got another one here.
Okay.
Okay. So this is a pretty simple one.
Okay.
I guess we got a borrower with a 614 credit score.
All right.
And loan amount's 475, 80 LTV, but it doesn't say if it's full doc or whatever. So I guess we could assume that we're a full doc deal.
Any kind of housing history mentioned there, or is it really probably just?
Nope, just the 614, the 475 loan, and 80 LTV.
Okay, all right, and, yeah. So yeah, when you get down below 620, that's a real big cutoff. That there's very, very few loans available. But you can look. We have a couple of options for the borrower, and really the difference between the two is seasoning from a bankruptcy. So if they have a 24-month seasoning, sounds like they do. Here's the 80%, the rates, all that. And then it says, again, we can go up to an 85 on either of these loans. So then you could just change it to 85, and there it updates rates and everything else. So simple. And then the other thing, right from here, Frank, if this was something that, this looks like a loan you might be able to put together, you click right here for a pre-qualification request. So then you would just select your account executive, and all this information would go right to the AE, and they'd get you something back in writing very quickly.
Gotcha. So there is another question that we have here, and that is, real quick before we move on to the next piece, we'll just go ahead and take this one. On your bank statement loans, is that for self-employed only?
Yes, bank statement loans require 2 years of self-employment.
Okay, excellent. All right, we're good. Yeah, let's continue on.
Okay. So, well, I'll tell you what. You mentioned the marketing piece. Why don't I go here just from our homepage? Once you're signed up with us, you would click log in, and when you click log in, you would have a username and a password. And all you would do is log in to our portal, and right here, marketing portal, presentations, flyers. So right here, flyers are what you were talking about. But here's all of our flyers. I'll pull up the bank statement one. But this is a bank statement flyer. Give it a second to upload. And this is where you would put your information. So there's nothing about Angel Oak anywhere on these flyers. And you put your logo, put your contact information. I don't know why this already has somebody's info in it, but that's fine. Those areas would be blank. You'd fill them out, and then you'd be good to go. But lots of different ones. You can email these out. You can post them on social media, print them, obviously, carry them out, hand them out. It's just a great way to start some conversations.
Definitely. It's so cool that you guys offer it. I mean, if you think about it on this webinar. Oh, by the way, guys, we'll get you. I can't remember. Do we get them a copy of the PowerPoint on this one, or do we?
Yeah, I mean, we can. There's really that'd be fine.
Yeah, I think Jackie's saying something. What do we? Want a copy of the PowerPoint? Yeah, no, we do. So it's a good thing we have our team working for us, Tom.
Right there. They're all ready to go.
Are actually running the shows around here. So yes, you guys are going to get that, just so you know. But and of course you're going to get a copy of this webinar. But I mean, you think about it today. You spent with us. We're at what are we at? We're at literally 40 minutes. Yep. We've spent 40 minutes thus far, and we've got a plan. We've got the plan to do. We've got the place to find the deals. We've got the marketing materials to go get the deals. This is a great webinar.
Yeah, and I'll tell you, here's another thing, a question that we get pretty regularly is how do I
Yeah.
find my AE? And
Yeah.
again, Angelo MS right here, it says contact Angelo, and it says find your AE. And right here is a map of the US. So you just click on a state. Let's just say, hey, we're from Texas, click on the state, and then all the AEs in Texas pop up. So you got John, who's the regional sales manager, and then the AE and their corresponding market. So real simple. Just remember our website. You can find everything you need.
While we're here, there are just a couple of more kind of questions that aren't really scenario questions. Do we want to field those now, or are we do we still need to go through some slides before we get there? Or
no, I think we're good, aren't we? Yeah.
I think we're good. Okay. So along that line, somebody is asking, I'm looking right now, how do they know if their company's approved already or not with Angelo?
You could either send an email to info@angelookms.com and we'll get back to you, or probably the best way is to find an AE in your market and reach out.
That's the best way.
Because if you're not, they can streamline and really help you. Our broker package is right here on the website, but they can look up real quickly and tell you whether or not you're approved and ready to go.
Okay, let me look here. Okay, do you guys do anything besides non-QM like FHA, VA, Fannie, Freddie, anything like that?
We do not. We are 100% non-QM and non-agency only. We don't do Fannie, Freddie, or FHA.
Okay, let me look. Oh, here's a good one. For reserves and down payment, can it be a gift or?
I love that one. And the answer is yes. You know, we look at that either have assets or access to assets. So yeah, a 20% down loan, if they only have 5% and they're getting a gift for the remaining balance, that's fine.
Okay. Oh, well, here's what everybody always wants to know. How fast can you do it?
Well, you know,
how fast can you close?
Yeah, I mean, that's a great question. And really that's why we've been able to grow our business as much as we have. You mentioned earlier, Frank, how we're kind of in the news, and a big piece of that is because of our speed and our service. Our average time from start to finish is 22 days. So we can get loans done quickly. One thing that and the majority of what we're doing today is probably 85% purchases. We know that the closing date on these contracts, even if maybe you as a loan officer tried to go down the agency road and then you found out something that you couldn't get it done, the closing date still hasn't changed. So, you know, we understand that we're getting that loan perhaps after it's already gone another route or two. So we really focus in on getting these loans and getting them done quickly. So, you know, get with your AE. They can map out the timeline for any specific scenario, but you know, 2 to 3 weeks is, you know, we do that all the time.
Okay. I got like one more here if we can get that one squeezed in.
Okay.
And she's saying will you guys make an exception to your own guidelines if it makes sense? I think that's what she's saying. If it makes sense, will you make an exception on your own guidelines?
Yeah. So the thing that is interesting about non-QM, what's exciting about non-QM is all these loans are manually underwritten. So when I showed you earlier how you submit a pre-qual request, you submit that scenario to our account executives, and they're highly trained, highly skilled on what we can and can't do. So even outside of our guidelines, where we can make make exceptions, because we do loans that make sense. And so the short answer is yes, but the long answer is we look at these loans individually. And if they're good loans, we'll see if there's some flexibility in our guidelines to actually make those loans.
Cool. I think we fielded pretty much everything here.
Okay.
I think we're good. I don't know if you've got a closing slide there that we can show some contact info or something, and then
yeah, that's yeah.
You're gonna get everything anyway, guys. Just so you know.
Yeah. Okay. Well, there you go. Yeah. It's my contact information. If anybody wants to call or email me, their information right there. Happy to help.
All right, cool. Well, with that, I think we're good. Again, guys, expect this to come in your email maybe by the end of the day today, or worst case, first part of tomorrow.
Yep.
You'll get the assets from all this, and I hope you engage it. I hope you go, heck yeah, man, let's go get some of these deals and let's start doing a couple of these deals a month, so that 2 years from now it's like, well, at least I know I got those 2 deals coming in. That's really what it comes down to. You
Yep.
know, so
Exactly what it is.
all right, well, great, Tom. Thanks again for being our sponsor and providing such great stuff for these guys. We really
Awesome.
appreciate it.
Thank you, Frank.
All right, you guys, we'll go ahead and get out of here, and we'll catch you on the next one. Stay tuned to the National Real Estate Post for our ongoing series of webinars with Angel Oak Mortgage Solutions. All right. See you, Tom.
Thank you, Frank. Talk to you soon. See ya.
Bye.